Welcome to VDR, your channel. 5th SEM Management Accounting Model Question Paper for all universities in Andhra Pradesh. Model question paper with the answers. We are explaining the now. If you like, share, subscribe and comment. Let us see this question paper model. Answer any 5 from the following questions. Define management accounting, explain it, features. Explain functions of management accountant. What do you mean ratio analysis? Explain advantages and limitations. Classification of ratios. It means profitability ratios or anyone can be asked. Profitability ratios or solvency ratios, turnover ratios. Next question. Uses for funds flow statement. Uses of funds flow statement. What is budget? Features and objectives. Explain, define report, purpose and objectives of report. What is good qualities of management report? Section B. Answer any one of the following questions. Unit 1. Define differences between management accounting and financial accounting. 10 marks question. Differences between management accounting and cost accounting. Okay. Unit 2. Ratio analysis. The balance sheet of G. Shravani as on 36 June 2015 is given below. Liabilities rupees, assets rupees. Liability side, equity share capital 1 lakh, 9% preference share capital 50,000, 8% debenture 50,000, reserves 20,000, creditors 4,500, 45,000. Okay. Next, fixed assets 1,80,000, stock 2,500, bank debtors 55,000, bills receivable 3,000, bank 2,000, total 2,65,000. Calculate debt equity ratio, current ratio, liquid ratio, debt equity ratio, proprietor ratio and fixed assets ratio. First, current ratio. Current ratio formula: current assets by current liabilities. Current assets by current liabilities. Stores or stock, same. 25,000, debtors 55,000, bills receivable 3,000, bank 2,000, total 85,000 current assets. Current liabilities, creditors 45,000, creditors 45,000. Okay, so current ratio formula: current assets by current liabilities. So 85,000 by 45,000, answer 1.88. Okay. Next, quick ratio. Quick ratio means current assets minus stock, means stores. 85,000 minus 25,000, 60,000. Quick liabilities means current liabilities minus bank overdraft. There is no bank overdraft, so current liabilities is a quick liability. 60,000 divided by 45,000. Okay, 1.33. Next, debt equity ratio. Debt equity ratio means debt by equity shareholder funds. So debt means debentures 50,000. Shareholder funds means equity share capital, preference share capital and reserves and surpluses. Okay, 1 lakh plus 50,000 plus 20,000, total 1,10,000. 1,70,000. 50,000 by 1,70,000, 0.29. Proprietary Proprietary ratio, shareholder funds by total assets. Shareholder funds means 1,70,000, total assets 2,65,000. Answer 0.64. Fixed assets ratio, fixed assets by total assets 1,80,000 by 2,65,000. Okay, so next sum. So unit 2, there is a ratio analysis. Two sums will be given in the ratio analysis. The following information calculate GP ratio, gross profit ratio, net profit ratio, operating ratio and operating profit ratio. So given question, opening stock 75,000, purchase 3,50,000, direct expenses 10,000, closing stock 1 lakh, administrative expenses 90,000, selling expenses 10,000, sales 5 lakhs. So prepare from the following, preparing trading and P&L account. To opening stock 75,000, to purchase 3,50,000, direct expenses 10,000, buy sales 5 lakhs, by closing stock 1 lakh. Total gross profit is 2 lakhs. Gross profit is 2 lakhs. By gross profit 2 lakhs. Administrative expenses 90,000, selling and inspection expenses 10,000, net profit is 1 lakh. GP ratio. GP ratio formula gross profit by net sales into 100. Gross profit here 2 lakhs. Net sales is 5 lakhs. So 2 lakhs by 5 lakhs into 100, 40%. Net profit ratio. Net profit by net sales into 100. Net profit 1 lakh, net sales 5 lakhs into 100, 20%. Operating ratio formula cost of goods sold plus operating expenses by net sales into 100. Okay, cost of goods sold, sales minus gross profit. Here sales is 5 lakhs, gross profit is 2 lakhs. So cost of goods sold is 3 lakhs. Operating expense means administrative expenses and selling expenses. 90,000 plus 10,000, 1 lakh. So operating ratio formula cost of goods sold 3 lakhs, operating expenses 1 lakh, net sales 5 lakhs into 100. 4 lakhs by 5 lakhs into 100, 80% operating ratio. Okay. Operating profit ratio, 100 minus operating ratio, 100 minus 80% equal to 20% is operating profit ratio. Okay. Unit 3. In Unit 3, in funds flow statement and cash flow statement, 2 chapters. Each one problem may be given in this unit. From the following balance sheet, prepare funds flow statement. Liabilities 2017, 2018. Assets 2017, 2018. Amount share capital 2,40,000, 3,60,000. Share premium 24,000, 36,000. General reserve 12,000, 18,000, 27,000. Profit and loss 58,500, 62,400. Debentures 78,000. Provision for tax 29,400, 32,700. Creditors 1,500, 1,09,200. Assets building 1,66,200, 3,39,600. Machinery 1,06,900, 1,53,900. Furniture 7,200, 4,500. Stock 63,600, 78,000. Bank 14,000, 12,000. Okay. Debtors 1,09,500, 1,17,300. Okay. So next adjustments. Provide depreciation on machinery 38,500, 400 on furniture 1,200. So let us see this solution. Statement of changes in working capital. Particulars 2017, 2018, increase in working capital, decrease in working capital. Current assets, stock, debtor, bank 63,300, 66,300, 78,000. If current assets increases, increase in working capital. Difference amount 17,000, 11,700. Debtors 1,09,500, 1,17,300. Increases 7,800. Bank 14,400, 12,000. Decreases in the working capital 2,400. Current liabilities, provision for tax and creditors. Provision for tax and creditors 29,400, 32,700. So current provision for taxes increases, working capital decreases. Creditor 1,500,000, 1,09,200. So current liability increases, working capital decreases. Next, total. So total the increase in working capital 19,500, decrease in working capital 14,500, which is low 14,400. So less it. So net increase in working capital 5,100. Net increase in working capital 5,100. Next, adjusted P&L account. So P&L account opening balance and closing balance should be the credit side, closing balance debit side. Reserve, difference amount in the balance sheet transfer to the P&L account. Depreciation of machinery, depreciation of furniture transfer to the adjusted P&L account. Okay, so difference amount transfer to the funds from operation 52,500. Next, so general reserve 9,000, difference in P&L account. Depreciation on machinery, depreciation on furniture 1,200. Okay, total 1,11,000 minus 58,500, funds from operation is 52,500. Next, funds flow statement. Sources amount, application amount. Equity share capital difference, sources debit. Share premium increases, sources debit. Debenture increases, sources debit. Funds from operation 52,500 debit. Sources, sale of furniture 1,500. Building purchase 1,73,400. Increase in working capital 5,100. If working capital decreases, debit side increases, credit side. Machinery purchase 85,500. So prepare machinery account, ledger account and furniture account. We can get the machinery purchase amount and sale of furniture account. Okay, let us see this another unit. From the following information, prepare cash flow statement. Liabilities 2017-18. Share capital 1,25,000, 1,53,000. Bank loan 40,000, 50,000. General reserve 25,000. Creditor 40,000, 44,000. Profit and loss account 1 lakh, 1,20,000. Liability side. Asset side. Cash 10,000, 47,000. Land and building 30,000, 50,000. Building 30,000, 50,000. Stock 35,000, 25,000. Machinery 80,000, 55,000. Land cash 10,000, 47,000. Debtors 30,000, 50,000. Stock 35,000, 25,000. Machinery 80,000, 55,000. Land 40,000, 50,000. Building 35, 60,000. Goodwill 1 lakh 80,000. Okay, adjustments. Dividend paid 15,000. 20,000 rupees worth of machinery sold at book value. Okay, prepare cash flow statements. Here the items which will become share capital will come in the financing activity, bank loan financing activity, reserve it comes in the operating activity, creditor operating activity, P&L operating activity, cash is last one, finance activity, debtor operating, stock operating, machinery investment activity, land investment, building investment, goodwill if decreases operating activity. Okay, let us see this solution. Cash flow statement. First category, cash flow from operating activity. Purchase amount. Profit and loss account 20,000. Okay, means here P&L account given 1 lakh and 1,20,000. The difference amount 20,000 is shown in the outer column. Next, proposed dividend 15,000. Depreciation machinery 5,000. Goodwill written off 20,000. add all those items. Less. Debtors increases, minus value. Stock decreases, plus value. Creditor increases, plus value. 6,000. Total answer is 54,000. Net cash flow from operating activity. Cash flow from investment activity. Purchase amount. Sale of machinery 20,000. Land purchase 10,000. Building purchase 25,000. So net cash used in the cash flow from investment activity. Answer 39,000. Next, third category, cash flow from financing activity. Share capital increases, plus value. Bank loan increases, plus value. Loan from financial institution decreases, minus value. Dividend paid, minus value. So net increase. So total answer is 2000 is minus value, cash flow from financing activity. All three answers. Net increase in cash 37,000. Opening cash 10,000. Closing cash is 47,000. Okay, this is the cash flow statement. Unit 4. The following expenses of a production 5,000 units in a factory are given below. Purchase per unit. Material 50 rupees, labor 20 rupees, variable overheads 15 rupees, fixed overheads 10 rupees, administrative expenses 5% variable 10 rupees, selling expenses 6 rupees 20% fixed, distribution expenses 10% fixed. Okay. Next, total cost 116 rupees. You are required to prepare production budget for 7,000 units. Production budget. So purchase per unit and 5,000 units. Purchase per unit 7,000 units. Material 50 rupees variable. So 50 into 5,000 2,50,000. 50 into 7,000 3,50,000. Labor 20 rupees. 20 into 5,000 1 lakh. 20 into 7,000 1 lakh 40,000. Variable overheads 15 into 5,000 75,000. 50 into 7,000 1 lakh 5,000. Fixed overheads 10 rupees. Fixed overheads are fixed. 5,000 units into 10 50,000. Same amount will be shown in the 7,000 units. So 50,000 by 7,000 per unit is 7.14. Next, administrative expenses. Variable 5%. So variable 5%. 10 rupees into 5%, 50 paisa. So 50 paisa into 5,000 units 2,500. 50 paisa into 7,000 units 3,500. Fixed 95%. 10 into 95% is 9.5. 9.5 into 5,000 47,500. Okay. The 47,500 will be shown in the 7,000 units also. So per unit will become 47,500 by 7,000 units. So is 6.78. Selling expenses. Variable 80%. 6 into 80% 4.8. 4.8 into 5,000 24,000. 4.8 into 7,000 33,600. Fixed 6 into 20% 1.2. 1.2 into 5,000 6,000. Same 6,000 will be shown in the 7,000 units also. 6,000 divided by 7,000 units 0.85. Next, distribution expenses. So 5 rupees into 90% variable 4.5. 4.5 into 5,000 4.5 into 7,000. Fixed 5 into 10% 0.5. 0.5 into 5,000 2,500. 2,500 same amount substituted in the 7,000 units also. So 2,500 divided by 7,000. Total 116 5,80,000 109.92 7,69,600. Okay. Next problem. Draw a flexible budget for overheads expenses on the basis of the following information. Determine overhead rate at 70%, 80%, 90% plant capacity. Particular 70%, 80%, 90%. Variable overheads, indirect labor 12,000, stores 4,000, semi-variable overheads, power 60% fixed, 40% variable, 20,000, repairs 60% fixed, 40% variable, fixed overheads, depreciation 11,000, insurance 3,000, salaries 10,000, estimated direct labor hours are 1,24,000 hours. Flexible budget for 70%, 80%, 90% capacities. Okay, particular 70, 80, 90%. Variable overheads. So variable overheads, 80% capacity amount given 12,000. So 12,000 divided by 80, not 80%, only 80, equal to get 150 rupees. 150 rupees. 150 into 70, 10,500. 150 into 80, 12,000. 150 into 90, 13,500. Same stores. Amount 4,000, 80% is given. 4,000 by 80, we can get 50. 50 into 70, 3,500. 50 into 80, 4,000. 50 into 90, 4,500. Okay, semi variable overheads. Power 60% fixed. So 20,000 into 60%. 20,000 60% means 12,000, 12,000, 12,000. Fixed expenses are remaining constant at any capacity. 40% variable. 20,000 into 40% means 8,000. So 8,000 divided by 80. So we can get to the 100. So 100 into 70, 7,000. 100 into 80, 8,000. 100 into 90, 9,000. Similar to repairs also. So repairs 60% fixed, 2,000 into 60%, 1,200, 1,200, 1,200. Remaining 800 rupees amount is variable. So 2,000 into 40%, 800, 800 by 80, 10. 10 into 70, 700, 10 into 80, 800, 10 into 90, 900. Next, fixed expenses. Fixed expenses are remaining at constant at all stages. So depreciation 11,000, 11,000, 11,000. Insurance 3,000, 3,000, 3,000. Salary 10,000, 10,000, 10,000. Total cost 58,500, 62,000, 65,100. Next, estimated labor hours are given in 1,24,000 at 80% capacity. So 1,24,000 divided by 80, we can get the 1,550 hours. So 1,550 hours into 70%, 70. 1,550 into 70, 1,08,500, 1,24,000. 1,550 into 90, 1,39,500, 1,39,500. Okay. Next, overhead rate per hour. So total cost by labor hours. Total cost by labor hours. Total cost by labor hours. So total cost is 58,500 by 1,08,500, 0.54. 62,000 by 1,24,000, 50 paisa. 65,100 by 1,39,500, 0.47. Okay. Unit 5. What is management reporting? Explain different types of management reporting. Next, explain needs and importance of the management reporting. Here, the all chapters like budgetary control, next ratio analysis, funds flow statement, the chapters videos are available in the VDR your channel. Thank you very much for public examinations.